Tulip mania. In the winter of 1637, in the Netherlands, a single tulip bulb was worth more than a skilled craftsman would earn in an entire year. Some rare bulbs were even traded for the price of a house. People weren't just buying tulips because they liked flowers. They were buying them because they believed prices would rise forever. And for a while they did. But when confidence snapped, the market collapsed almost overnight. Tulip bulbs that were selling for thousands of guilders suddenly couldn't fetch even a few coins. Fortunes vanished, banks wobbled, and households across the Dutch Republic were left devastated. The Long Depression. After the small financial panics of the early 1800s, the world entered one of the most misunderstood recessions in history, the Long Depression. It began in 1873 when a major Austrian bank, Credit Anstalt, collapsed after speculating heavily on railroads. That shock rippled across Europe and jumped the Atlantic to the United States. In New York, Wall Street saw its first real Black Friday. The stock market closed for 10 straight days to prevent complete panic. So what caused it? The short answer: too much money poured into railroads. Investors believed railways would stitch together continents and generate endless profits. Banks, flush with cash, lent recklessly. But as more railroads were built, supply outstripped demand. Lines ran half empty, profits dried up, and loans went unpaid. When the bubble burst, banks failed. Businesses collapsed. Farmers, who relied on railroads to sell their crops, were devastated by falling prices. Trade slowed and confidence evaporated. How bad was it? In the US, over 18,000 businesses went bankrupt during the first 5 years alone. Unemployment spiked to around 14%. Wages for those still working dropped by nearly a quarter. Across the Atlantic, Britain, then the world's financial center, slid into decades of sluggish growth. What made the Long Depression unique is its sheer length. While other recessions lasted months or a few years, this downturn dragged on for nearly 2 decades, depending on how you measure it. From 1873 until the mid-1890s, the global economy never truly regained its pre-crash momentum. Now, here's the twist. Not everything looked bad on the surface. The period was marked by rapid industrial innovation: steel, electricity, telegraphs. But because productivity was rising so fast, prices kept falling. Economists call this deflation. Imagine being a farmer or factory worker and watching the price of your goods fall year after year, while your debt stayed the same. For ordinary families, it felt like the economy was permanently broken. The Long Depression taught the world 2 lessons. First, global markets were now deeply interconnected. What started in Austria and Germany spread everywhere. Second, recessions aren't just about how deep the downturn is, but also how long it drags on. The Great Depression. It began with the Wall Street crash of October 1929, when stock prices fell by nearly 25% in just a few days. Investors panicked. Banks that had loaned money for speculation were suddenly on the hook for billions. But here's the truth. The stock market crash was just the spark. The deeper causes had been building for years. During the Roaring '20s, the US economy had grown rapidly, but much of it was fueled by debt. Ordinary people were buying stocks on margin, borrowing 90% of the money they invested. Factories were overproducing goods, but wages weren't keeping up, so people bought on credit instead. Underneath the prosperity was fragility. When the crash came, the whole system unraveled. Banks failed by the thousands, wiping out people's savings. Because deposit insurance didn't exist yet, businesses couldn't get credit. Farmers, already struggling with falling crop prices, saw demand collapse entirely. Families were evicted from their homes. By 1933, 1 in 4 American workers was unemployed. The pain was everywhere. Bread lines stretched for blocks in every major city. Farmers in the Midwest faced not only low prices, but also the Dust Bowl, drought and dust storms that made it impossible to grow crops. Children went hungry. Families migrated by the thousands in search of work. And it wasn't just America. The Depression spread worldwide. Germany, already crippled by war reparations, saw unemployment rise above 30%, fueling social unrest and the rise of extremist politics. Britain, France, and much of the industrial world faced stagnation and mass hardship. Global trade shrank by two-thirds. This was more than a recession. It was a collapse of confidence in capitalism itself. For many, it seemed like the economic system simply didn't work anymore. Governments at first made things worse. In the US, the Federal Reserve tightened monetary policy instead of loosening it. Congress passed the Smoot-Hawley tariff, which triggered retaliatory tariffs abroad and strangled world trade further. But eventually, new ideas emerged. In America, Franklin D. Roosevelt launched the New Deal: public works programs, social security, banking reforms, and regulations on Wall Street. Globally, governments began experimenting with Keynesian economics. The idea that when private demand collapses, the state must step in with spending to revive the economy. The Great Depression lasted a full decade. By some measures, economies didn't truly recover until the massive mobilization of World War II. But its legacy is permanent. It gave us deposit insurance to protect savings. It gave us unemployment benefits and safety nets. It taught governments that recessions, left unchecked, can spiral into something far worse, a depression. And it reshaped politics. Out of the Great Depression came stronger labor movements, the rise of welfare states, and unfortunately, in some countries, the rise of authoritarian regimes that promised solutions through radical means. The Great Depression wasn't just the deepest recession in modern history. It was a turning point. It showed the world the stakes of getting economic policy wrong, and it cemented the idea that governments can't just sit back during a downturn. They have to act. The oil shock recessions. In the 1970s, the world was hit by not one, but two major recessions, both triggered by oil. The first came in 1973, when members of OPEC, the Organization of Petroleum Exporting Countries, imposed an oil embargo in response to US support for Israel during the Yom Kippur War. Almost overnight, oil prices quadrupled. This sent shockwaves through the global economy. Gasoline shortages hit the United States and Europe. Long lines formed at petrol stations, with drivers sometimes waiting hours just to fill their tanks. Factories dependent on energy cut production. Transportation slowed. Inflation surged because oil is the backbone of modern economies. When energy prices rise, the price of everything rises. The US officially entered a recession in late 1973, which lasted into 1975. GDP shrank, industrial production plummeted. Unemployment climbed above 9%, the highest since the Great Depression. Across the Atlantic, Britain and Western Europe suffered just as badly. For ordinary families, it meant lost jobs, soaring heating bills, and a sudden sense that prosperity wasn't guaranteed. Then, barely had the world recovered when it happened again. In 1979, following the Iranian Revolution, global oil supply was disrupted once more. Prices doubled, again. The shock tipped the US and many other nations into another recession, one that lasted into the early 1980s. This second oil shock was brutal. Inflation in the US hit 14%. Mortgage rates soared above 18%, making it nearly impossible for families to buy homes. Unemployment hit 10% by 1982. Stagflation, high inflation, and high unemployment at the same time became the defining economic challenge of the decade. It's easy to call these energy crises, but make no mistake, they were true recessions. Output fell, jobs disappeared, businesses closed. And unlike earlier downturns caused by speculation or financial bubbles, these recessions were caused by an external shock, something completely outside the control of consumers or central banks. That's what made them so painful. You couldn't fix oil shortages with lower interest rates or government spending. The only real solution was to adjust, build more fuel-efficient cars, invest in alternative energy, and diversify energy supply. The oil shock recessions left a lasting scar on economic thinking. They forced central banks, especially the US Federal Reserve under Paul Volcker, to wage an all-out war on inflation, even if it meant pushing unemployment higher in the short term. And they taught a sobering lesson. Not every recession comes from within the financial system. Sometimes recessions are sparked by the world outside, geopolitics, natural resources, and the simple reality that economies don't run without energy. The dot-com bust. In the late 90s, investors fell in love with the internet. Companies with no profits, or even no products, were raising billions just because they had .com in their name. Stock prices soared, and then, inevitably, they collapsed. Between 2000 and 2002, the Nasdaq lost nearly 80% of its value. Thousands of companies went bankrupt. While the overall economy recovered relatively quickly, the dot-com bust was a harsh reminder of what happens when speculation runs ahead of reality. Next up, the mother of modern recessions. The global financial crisis of 2008. This time, the bubble was housing. Banks issued risky mortgages, bundled them into complex financial products, and sold them worldwide. For a while, everyone thought housing prices would rise forever. But when homeowners began defaulting, the entire system unraveled. Lehman Brothers collapsed, credit markets froze, and global trade ground to a halt. The result? The worst recession since the Great Depression. Millions lost their homes, unemployment soared, and governments had to bail out banks to prevent complete collapse. The scars of 2008 are still with us today: rising inequality, political polarization, and a generation that became far more skeptical of the financial system. Thanks for watching. Make sure you like and subscribe. It really helps me out.